Welcome to Module 4. Now that we've learned how to report income, it's time to explore deductions, credits, and adjustments. These are crucial because they can reduce the amount of income that is taxed, meaning your client could pay less in taxes or get a larger refund. Whether your client is taking a standard deduction or itemized, deductions can make a big difference in their tax return. And if they're self employed, we'll also dive into specific deductions available for them through the Schedule C. So, what is a deduction? A deduction is an expense that reduces your taxable income. Think of it as a way to lower the amount of income that the IRS can tax. For example, let's say your current client has an annual gross income of $65,000 that year. If they have $7,000 in deductions, their taxable income can get reduced to $58,000. That means they're only going to be taxed on $58,000 instead of the full $65,000. As you can see, deductions can make a big impact. Now let's talk about the two main types of deductions. You have standard deductions and you have itemized deductions. The standard deduction is a fixed amount that every taxpayer can claim to lower their taxable income. No questions asked. For 2024, that amount is $13,850 for single filers, $27,700 for married couples filing jointly. For a married filing separately, that will be $14,600. And for head of household, that's $21,900. On the other hand, itemized deductions are based on specific expenses like mortgage interest, medical bills, and charitable donations. If these itemized expenses add up to more than the standard deduction, it's worth using them instead. Otherwise, most people will take the standard deduction. Medical and dental expenses, these are deductible, but only if they exceed 7.5 of the adjusted gross income. Now, we have mortgage interest, which is a big one for homeowners. Interest on mortgages up to $750,000 is deductible. Charitable donations are also deductible as long as they're made to qualified organizations. And finally, state and local taxes are deductible up to $10,000. For many taxpayers, these itemized deductions can add up to more than the standard deductions, making it worth the effort. So let's look at an example. Imagine a single filer has an annual gross income of $50,000. If they claim the standard deduction of $13,850, their taxable income is reduced to $36,150. This means they only pay taxes on $36,150 instead of the full $50,000. That's a big saving. The standard deduction is a quick and easy way to lower taxable income for most people. Let's go through an example of itemized deductions. A single filer has an annual gross income of $70,000 and the following deductions. They have $8,000 in mortgage interest, $2,000 in charitable contributions, $3,000 in medical expenses, and that totals $13,000 in itemized deductions. However, since the standard deduction for single filers is $13,850, this client would choose to take the standard deduction because it is higher. This is why people end up using standard deductions unless they have a significant amount of itemized deductions. Now, let's talk about Schedule C deductions for self-employed individuals. Running a business comes with its own expenses, and the IRS allows people to deduct these costs from their income to lower their taxable income. Some common deductions for self-employed include supplies like office materials, software, and other items needed for the business. Then you have advertising, money spent on marketing, online ads, or social media promotion. And then what about vehicle expenses? If they use their car for business purposes, they can deduct mileage or actual vehicle expenses. Home office deductions. If they work from home, they can deduct a portion of their rent or mortgage and utilities if the space is used exclusively for business. These deductions can significantly reduce their taxable income, especially if they have high business expenses. Now, here is a full list of different deductions small businesses use. Please feel free to pause the video and screenshot this for future references. So let's walk through an example. Imagine a freelancer earns $100,000 in gross income. They have the following Schedule C deductions: $2,500 for office supplies, $5,000 for advertising, $3,500 for vehicle expenses, and after deducting these business expenses, their taxable income is reduced to $89,000. Instead of being taxed on the full $100,000 that they had made, they're only taxed on $89,000, which means they'll owe less in taxes. Deductions like these are extremely valuable for self-employed individuals. Here's another example. Let's consider a situation where your client works a full-time job and also started a side business. In their first year, they invested heavily in their business but did not make a profit. Here's what that looks like. They earned $80,000 from their full-time job, reported on their W-2. Their side business brought in $10,000 in revenue, but they had $15,000 in business expenses, leaving them with a $5,000 loss for the year. That loss doesn't just disappear. It can be used to reduce the taxable income from their full-time job. So instead of being taxed on the full $80,000, their taxable income is reduced by the $5,000 loss from their business. Now they're only taxed on $75,000. This is one of the big benefits of claiming business expenses, especially in the first year when clients often have more expenses than revenue. Next, we have adjustments to income, which reduces your AGI even before you apply deductions. This lowers your taxable income and can even qualify you for other tax credits. Some common adjustments include student loan interest deductions. If your client paid interest on student loans, they can deduct up to $2,500. Retirement contributions. Contributions to your retirement account, like IRAs, can be deducted. Now, let's shift gears and talk about tax credits. While deductions reduce your taxable income, tax credits directly reduce the amount of taxes you owe dollar for dollar. If you owe $5,000 in taxes and have a $1,000 tax credit, your tax bill drops to $4,000. There are two types of tax credits. You have refundable and non-refundable. What's the difference? A refundable credit can take your tax bill below zero, meaning the IRS will send you a refund. An example of this is the Earned Income Credit. Non-refundable credits like Child Independent Care Credit can reduce your bill to zero, but they won't give you a refund beyond that. Both types of credits are valuable, but refundable credits tend to have a bigger financial impact for taxpayers. Some of the most common tax credit include the Earned Income Tax Credit, which is designed for low to moderate income earners and is refundable. Next, there is the Child Tax Credit, which provides up to $2,000 per qualifying child and is partially refundable. The Child Independent Care Credit helps cover the cost of caring for children or dependents while you work, but is non-refundable. Finally, we have education credits like the American Opportunity and Lifetime Learning Credits, which can help offset the cost of higher education. These are just a few examples, but they can have a major impact on reducing tax liabilities. Just like I said in the previous video, do not wrap your mind around trying to fit all of this into your brain. The great thing about tax preparation, the tax software that you'll be using automatically calculates all of this for you. Deductions and credits work together to reduce your client's overall tax bill, but they do it in a different way. Deductions lower your taxable income, meaning you're taxed on a smaller amount. Credits, on the other hand, directly reduces the taxes someone owes. By combining these tools effectively, you can drastically reduce the amount of money your client sends to the IRS. It's all about using them strategically, first to reduce taxable income with deductions, and then apply credits to shrink the tax bill even further. As we wrap up this module, remember that deductions and credits are your secret weapon in tax preparation.